like, what's the dream of? What's the hope in? What's the doubt for? Live to no end. This is living. The life I've been given is a gift. If I'm a living, I'ma live it to death. So what's the dream of? What's the hope in? What's the doubt for? And live to no end. This is living. The life I've been given is a gift. If I'm a living, I'ma live it to death. Yeah.
All right, what's up, everybody? Welcome to the Living Hope Agency Call. My name is Jamie Chirio, and I'm here with Agency Manager, Mr. Josh Lockhart. And today we are talking about how to put the client in the right position every time. Now, this is not an underwriting call, like we prefaced before. We're not here to tell you, hey, this company over that company. We're going to talk about different scenarios and different solutions in which maybe you need to propose, hey, I'm not going to go that traditional route. You know, a 75-year-old who wants $300,000 worth of term insurance, that might not be the best solution for them, you know, for multiple reasons, qualification, pricing on the budget, et cetera. So we're going to really just go through multiple scenarios of like, what direction would I go, and kind of go back and forth and just kind of see what happens. So Josh, what are your thoughts right now?
Well, absolutely. I mean, very, very quickly, when I first started meeting with clients, you get home and you have people that on both sides of the fence, they have no idea what they want. And then some people, they tell you what they want. And you're like, in your back of your head, you're like, there's no way you can get that. Either you can't afford it, you can't qualify. And so when you become a professional at this, right? When you become master at your craft, you go from, I'm going to help the client get what they want to, regardless of what they want, I'm going to help them to get what they need. And sometimes that is two different things. Namely, I think of a scenario where I was talking to a 42-year-old nurse, and she made six figures. I get to her house, and her main objective is she wants to leave money behind for her kids, right? That's what she said. It wasn't mortgage protection. Just, I want to leave life insurance money to my kids. She says, I want to leave $1 million policy. Very, very quickly, we figure out she does not want to afford $1 million policy. So instead of just leaving the house and going, well, okay, and she's like, I'm not paying that much, we left with a $10,000 whole life policy. Worlds are different. It was only like $40 a month, but the client was served. I made a sale. And the most important thing was, she is not going to leave a bill behind to her family. And so why don't we start there, Jamie, it doesn't have to be a 40-year-old. It could be the 65-year-old person that maybe has some health complications. And we show up, they've filled out a form, and, because they've seen an ad online, on TV, you sit down with them, they're on a fixed income. Because I think a lot of, final expense people or people looking at that tend to be, and they go, you're going through things. They're like, hey, Jamie, can I get like a, $200,000 policy, right? They just throw out an arbitrary number. What kind of conversation would you have with them to steer them in the direction of what they need versus just this arbitrary number that they think they want?
Well, first of all, when I was brand new, I probably would have said, yeah, absolutely, if you can qualify. And then I would have went through quoting them, and then it would have been $969 a month. And then they would have kicked me out of the house, or they would have just been totally turned off to anything else that I show them. So now, if I'm sitting down with 65-year-old Jim, who has a lot of health complications, and he says, can I get a $200,000 policy? No, Jim, that's not going to work. So really it's about, when I sit down with somebody, it's like, well, hey, Jim, why do you want a $200,000 policy? I just wanted to because here's the thing, if there's a need there, then you could absolutely potentially sell that. Maybe he has the income, maybe he has the need, maybe it makes sense. I've seen those types of policies sold, but most of the time I ask Jim, why $250,000? And he says, it sounded like a good number, because I want the big policy. Okay, well, what are we actually protecting? Well, I really just need money for my final expenses. Okay, so you're not protecting a giant debt, a giant mortgage. You're not leaving behind, a bunch of inheritance taxes. Like, what's going on here where you need such a large policy? And you very quickly can find out that the need is not always there. Now, also the affordability side of things. Hey, sometimes I will talk, I'll just say, hey, 200,000 sounds great. That may or may not be the right fit for you. What we're going to do is we're going to go ahead and we're going to ask you some health questions to find out if you can even, number one, qualify for that. And number two, obviously, we're going to find something that makes sense for your budget. The other thing that I always like to do with someone who's older, who wants a lot of coverage, who I know can't afford it, rather than just straight up telling them, no, you cannot afford it, Jim. In that scenario, I might, use hey, here's what most people do. So that's always my go-to is, hey, Jim, what most people typically do in your situation, because people want to do what most people do. What most people typically do in your situation is they typically leave behind 10,000, 20,000, 30,000 for XYZ reason. Now, obviously, so I'll dig a little bit deeper. So in this scenario, Jim wants $200,000 worth of insurance, and obviously he's got some health complications. So he could probably only qualify for, let's say, 30. What's the reason why he wants the insurance, Josh?
He wants to not leave a bill behind, and he's got two sons that, he wants to leave a little bit of money behind.
Okay. And so you just be Jim for a second. Okay, Jim. So what kind of debts do you have? Do you have any mortgage payment, car payment, anything?
No mortgage, paid off. And yeah, I got a, I don't know, probably a year left on my car and a small little credit card from JCPenney.
Gotcha. Okay. Understood. And do you want to be buried or cremated?
Buried. Don't burn me twice.
Okay, fair enough. Okay, so you want to be buried, and then really fair to say that outside of the burial, anything else, you just want to make sure that you can leave some money behind for your kids?
Yeah. Two
Okay,
sons.
gotcha. So with the $200,000, what was like the reason you thought $200,000 sounded good?
Saw something online, looked like you could get some cheap insurance if you were, relatively young.
Yeah, totally understand that. So obviously, Jim, you're 63. You've got, this list of medications here. And Jim, even if you could qualify for the $200,000, this is always my little key here. Jim, if you were my dad, I probably would steer you in a little bit of a different direction, because even if you could qualify, that's probably going to take some food off the table. So really what we need to do is, the only life insurance, Jim, that matters is the one that you can actually have when you die, the one that you can actually afford every single day for the rest of your life. We need to make sure this is something that is not going to be the thing that stresses you out. It's going to be something that provides peace of mind. So if your funeral was paid for and your sons had some money in their pocket and it was affordable, would that leave you peace of mind?
Yeah, it would.
Okay, understood. So here's what most people typically do in your situation, Jim. Most people typically want to make sure that they can leave behind at least enough money, ballpark, for the funeral. And obviously we need to check to make sure that's even affordable. If that's, the affordable option, then that's what we're going to do. But at the end of the day, we want to leave a little bit extra behind. So we're obviously going to check your budget to see if it will allow for that. So no matter what we're going to do here is we're going to make sure the funeral is taken care of. But if possible, we're going to leave a little bit extra behind for the kids. Now, it's probably not going to be 200,000, but it might be, 10 or 20,000 for the kids.
Okay, fair enough.
Okay. Any objections you might throw that someone might throw out in that scenario?
Yeah, I mean, what about the thing online? What is that about?
Oh, there you go. Yeah. So in regards to, okay. So here's how I would probably handle that. What about the $9.95 commercial? What about the thing online that said I can get $500,000 for $15 a month? Okay. Hey, Jim, did you read the little disclaimer that you probably had to put, like, and I probably wouldn't say this. Hey, Jim, did you put your reading glasses on to read the disclaimer on the TV? The little disclaimer says for a 23-year-old with no medications. The little disclaimer at the bottom says $9.95 per unit of insurance, and a unit of insurance is $1,000. So here's the thing, life insurance is all state regulated, Jim, meaning that at the end of the day, the pricing has to be similar. So if you got two gas stations are also state regulated, across the street from each other. The Shell station can't charge $10 a gallon, and the Speedway across the street charge $5 a gallon. It has to be within a couple of dollars and cents. So if you see two policies and they're both $10,000 policies, and one's $100 a month and one's $10 a month, you got to have your red flag go up there and realize that there's something not adding up here about these two policies. And one policy has to be different than the other. If they have identical benefits, identical riders, identical time periods, everything, they're going to be within a few dollars and cents of each other. If one's $10 a month, I'm thinking it's probably accidental only, or I'm thinking it's one that's going to increase in price every couple of years. So really, at the end of the day, the TV commercials, the internet, whatever you saw, a lot of it's to get you to click on it so that you fill it out, so that we can have a conversation. I can't, the $9.95 commercial, I actually called up with one of my clients. She was 72. And I was like, hey, I'm just going to prove it to you, Mary, that, it's not $9.95. And by the end of it, it was like $223 a month, after all the costs of, units of insurance. So it's the introductory deal that gets you in the door. It's the disclaimer that gets you to call, but it's never $15 for $1 million worth of life insurance, unless you're like 18 years old and the term's 2 years long. So that's probably how I would break that down. But like the goal is education. It's not trying to like belittle Jim and be like, hey, you can't get that. It's like, hey, I totally understand where that misunderstanding is coming from. There's a lot of misinformation out there. Let me just kind of educate you on how life insurance works. The older you get, the more expensive that it gets. And obviously you're on a fixed income. Even if you could qualify for 200,000, Jim, it's like, if you're my dad, I would never let you pay $600 a month ever. Like that makes no sense. So we need to find something that's affordable, that you can afford for the rest of your life. That's probably how I would tackle that one.
Yeah. Yeah. No, that's good. That's good. So, a few different scenarios that I'm thinking of right now. We'll move over to the mortgage protection side of the house.
Yeah.
Something I heard you handle the other day. I really liked how you did it. So, couple scenarios that you could run into. One of them is always a little peculiar, right? So it's, let's say you have John and Mary. Okay. John is, I don't know, 53, 49. Mary's like right in there, the same age. And, John makes, $6,000 a month, and then Mary makes either 2 or nothing. Okay. And then their mortgage is like $3,000 a month. Right. So it's like, okay, you can tell that things are, like they're paying their bills, but they're probably not doing a whole lot more. And at first they're like, yeah, we both want coverage, but we're not real sure. What's the price? How do you handle that scenario?
Yeah, I think that's a big one. So I think this is always my go-to line. If I have a husband and wife, and let's say husband's the breadwinner, and it can go opposite. I can't tell you how many times the wife's been the breadwinner, but let's just say in this scenario, husband's the breadwinner making 6, she makes 2. I'd say, Bob, Mary, or John, Mary, however you said it. Can we both agree that if either one of you pass away, it's going to be equally emotionally devastating? And I always go, yes. But can we also agree that if John passes away, it's not just going to be emotionally devastating, but it's going to be financially devastating for Mary. Mary, if you pass away, no offense. Again, like I said, John is equally emotionally devastated, but he can still probably figure out the bills. If something happened to you, he might take some overtime, but he'd figure it out. But if something happens to John, you're going to lose the house, right? Yes. Okay. So do you guys see why it might make sense for us to focus the majority of our efforts here on making sure that John is covered? And if there's anything left over, we'll put a small policy on Mary to make sure that obviously everything's taken care of. But it makes sense that we should probably focus the majority of our efforts on John.
So would you try to steer that conversation into, let's try to get, if possible, a full mortgage payoff on John? And then, like you said, because you've broken down the budget, if there's something left over, then get a little something on Mary. Is that what?
Yeah. So, I mean, it all depends. So if I come down to it and, the mortgage is 250,000 and 250,000 on John as a 49-year-old guy, it's a couple $100 a month, and it's just 250 a month, 300 a month. And at that point, if they've got leftover budget, maybe at that point I might say, hey, we'll do a full mortgage payoff on John and maybe, 50% mortgage payoff on Mary, because then at least at that point, if something happens, we can pay off half the mortgage. John can refinance it, bring that payment down to basically, if it's a $3,600 mortgage and they bring it down to a $1,500 mortgage, he basically has made up 75% of her income by paying off that mortgage. Yeah. And, I'm able to kind of shape it that way. But a lot of the times, it just comes down to, one of my most popular policies when I'm trying to just take care of the husband and keep it cheap for the wife is I'll do a full mortgage protection on the husband. And then I'll add on a spousal accidental policy, so she feels like she's included.
That's good.
So I'll be like, hey, John obviously makes the most money, so we're going to do something $250,000 if he dies, $250,000 if he has a heart attack, stroke, cancer, becomes disabled. If nothing happens, they're going to give him all of his money back, and it costs $289 a month, and here's your cash back. But I think it makes sense that if this is kind of a no-brainer. Me and my wife, we have this. It's actually $500,000 worth of accidental on the both of us. And it's one policy. So it's not 2 policies, one for each of you. It's one policy that covers the both of you. Hey, John, if you die in an accident, not only will the 250 from the first policy pay out, but $500,000 from this policy will pay out. Mary, if you die in an accident, $500,000 is going to pay out. And if you guys are driving to the grocery store together, you both pass away, God forbid, $1 million will pay out to your kids. And it's only $89 a month for the both of you, or $120 for the both of you, and you get your money back at the end. And you guys see why that's a really good deal. And it's so cheap. And that's one premium for the both of you. And a lot of times it makes a lot of sense. Like that's where it started for me. Like if we go to, my personal scenario for life insurance before, now we have a few more comprehensive policies now that we have kids, but it started off, I was working, my wife was staying at home. I put the bulk of the, normal, life insurance with living benefits on myself. And I took out a $500,000 policy on each of us for accidental just to make sure she had something. And then we went back and later on, we added on some things when the budget allowed it.
Well, that's really good because I think a lot of us, especially when we're newer, we run into many, many scenarios where we're talking with a client and we kind of have this feeling either they're going to get what they're going to be able to cover everything or they're not going to buy anything.
Yeah.
Right. I want the $50,000 whole life or I don't want anything. I want a full mortgage payoff or I'm not even going to worry about it. And I've heard you so many times, do a bunch of different scenarios where maybe they don't cover all of it. Something's better than nothing. So the opposite of that scenario is same John and Mary scenario, right? They have a total of $6,000 a month in, household income split pretty much evenly between the two of them. And the mortgage is, $2,700 a month.
Mm-hmm.
And so it's like, okay, we can't both afford a full mortgage payoff. Mm-hmm. How do you have that conversation and what's that look like to put in place for them?
50-50 payoff. So that's always my go-to in that scenario. So equal income. If I can't afford full mortgage payoff for both people, I do 50% mortgage payoff for both. So they both make $3,000 a month. Neither of them can afford the $200 a month payment for each of them, but they can both afford $100 each. So now I say, hey, instead of $250,000 mortgage, we'll do $125,000 mortgage payoff for each of you. If one of y'all passes away, half the mortgage is paid off. You're going to refinance it. You're already paying half the mortgage with half your income, with half the household income. So now it's like the rest of the bills, obviously it's going to, we're going to probably lose a car payment. Our utilities are going to cut in half. Our grocery bill is going to cut in half, but also the mortgage payment's going to cut in half. And a lot of the time you're able to propose that solution and it makes a lot of sense. So sometimes, rather than, hey, full mortgage payoff for everybody, that scenario could be, I'm only going to pay off the mortgage on the breadwinner and we're going to get nothing for the spouse. It could be half mortgage payoff for each person. If it comes down to budget, sometimes I'm even like, hey, John, Mary, what's the absolute, like they've already seen a couple of quotes. So now they've got an idea of what they can afford and what they can't afford. And they've already said they can't afford the full payoff. I go, what's the most that you could possibly afford to put into this type of coverage? I see how important it is to you guys. What's the absolute highest in your budget would allow for total insurance? And I'll see how I can kind of shift that around your needs and get you the most coverage possible for the both of you. And if they go, we can't spend more than 250 total, I go, okay, well, maybe we spend 150 of that on John and 100 of that on Mary. And here's what you could get for that. Or we'll spend 200 on John and 50 on Mary, or we'll spend 125 on each of you guys. And here's what you'd get and your different ages, et cetera. And I try to, build it around their budget, but then also, based around kind of the need. So when you're doing the financial inventory, it's not just the, what product to write because of their health. It's what is going to be the financial situation of the survivor. Either way. So if I'm doing the financial inventory, we could do this with every single one of these scenarios. Husband, wife, single person. If it's a husband, wife, husband's income versus wife's income versus total household income. What are the expenses? What's coming in? What's going out? What is Mary's ability to pay the bills after John passes? What's John's ability to pay the bills after Mary passes? Okay, I've got, John and his son, Bill. What happens if John passes away? Can Bill take over that mortgage payment? Does he have a mortgage of his own? Like, what's that situation? What's the financial situation of the survivor? And when I see what the financial situation of the survivor is, it usually very easily allows me to prescribe a solution.
Now, here's an objection that I've gotten with couples enough to where I've kind of formulated my script to handle this ahead of time. Yeah. And I don't know how much you get this is like, hey, can't we just get one policy? Does that ever come up to you?
It absolutely has. I'd love to hear how you do it.
So as I'm going through it, I start this is a part of what I say in the beginning. As we're going through it, I'm like, hey, John, Mary, maybe you've heard sometimes people ask, hey, can't we just get a joint policy? They're like, yeah, that's what we want. I'm like, hey, there might be like one or two companies that if your health matches up, that price, the age matches up, you might be able to do it. But here's the downside. Even if that's a possibility, it's not actually a joint policy. It's like John's the owner and Mary's just what's called an additional term insured, and you don't have any of the same benefits. You don't have any of the same living benefits. She's just kind of like riding your back on the policy. And that's, I know that's not what you want, and it's really not even a significant savings. So
Yeah.
you'd prefer to have both, all the benefits, right? Then you never have to talk about it again.
Yeah. And also just being like, well, guys, how do you, hey, just so you guys know, like we don't qualify for insurance based on our credit score. We qualify for insurance based on our health. So like, John, you're taking 65 medications, and Mary, you don't take any medications. How do you guys expect to be in the same level of qualifications? Like, do you guys realize how much insurance fraud would probably be committed if the guy on 65 medications could just get on his wife's policy? Like, that doesn't make sense for the insurance companies. The
It'd be a
guy,
good deal.
the guys who's got, active congestive heart failure can't just jump on the policy of his marathon running wife and just get $1 million in coverage. That makes no sense. You guys agree, right? Like, yeah, that makes sense. So everything's individual underwriting. It's based on your individual, age, health, height, weight, medications.
Okay, so we'll keep moving up the age scale here. So there's a couple different scenarios. First one is equity protection. We'll move into
Okay.
that. So this is going to be your 72-year-old head, and either they're on a fixed income. My favorite is the one that seemingly doesn't care about paying off the house because their kids are probably just going to sell it anyway, right? So how do you frame up equity protection? Because when I first started hearing about it, I thought it was just like an interchangeable word we had for whole life.
Totally. Yeah. And I could totally see why someone might make that distinction. So, when it comes to equity protection, like I almost, if I have somebody that I know is older and I see how much they make per month and I see the types of medications they take, and even sometimes a perfectly healthy 72-year-old, just because they can qualify for term doesn't mean that's necessarily what I'm going to go ahead and pitch. So I think, for me, I'm leading somebody in a direction that I want to take them rather than getting to a point where either they have to say no or I have to say no. It's like, I have to say no when I tell them the insurance carrier denied you because you're too unhealthy. They have to say no when they look at the budget and say, I can't afford $800 a month. So I don't want to get in that scenario, because when they say no, I have to backtrack. You have to be on like what's called your back foot. I don't like being on my back foot. I like being on my front foot. I like knowing that everything that I'm doing is very intentional. So I'm like building them up to this idea of equity protection with the same exact principles I talked about in the beginning. Hey guys, here's what most people in your situation typically do. That's like, if you guys ever hear us do a live dial, that's like one of my go-to lines for getting people to do what the crowd is doing. So, hey, here's what most people typically do. Hey, John, real quick, just a couple questions. You'd mentioned that, you get your son, John, he'd be the beneficiary. Yes. Okay, perfect. So you wanted to make sure that if something happened to you, that John wouldn't have to come out of pocket for the mortgage, correct? Yes. Okay. And does he live local or does he live close? Maybe they answer local. He lives right down the street. Okay, great. No, he lives out of state. Okay, great. No matter where he lives, does he have his own place? Does he rent? Does he own? Does he have a family? He has his own rent and mortgage payments? Okay, great. Because a lot of you guys are going to get the scenario of, well, my son's a lawyer and he's an engineer and he's doing really well. And he could just afford this, we're fine. And I always want to know, like, do they have their own kids, their own bills, their own anything? Because I don't care who you are. I don't care if you're a lawyer making 12 grand a month. Another $2,000 mortgage is a hit. I don't care who you are, just because you're doing well, to carry your passed away father's mortgage payment just because he didn't have like the forethought to leave you something behind. Like, yeah, I'll do it because I'm obviously gonna get a payoff, but like, I don't really want to come out of pocket for this. Like, I really wish you would have left me something. So I'm kind of painting that picture for the client of, okay, so yeah, your son is doing pretty well as a lawyer. I'm sure that if you talk to him, he probably would say, I'll take care of this, but also like, that's your kid. Those are your grandkids over there. You really want to take $2,000 off the table and food off the table for them? No, probably not. So here's what most people typically do. You said that your son's got his own house. I doubt that he's moving from Washington over here to Albuquerque, New Mexico. I doubt that he's doing that. So, probably, he's going to sell the house, right? Yes. Okay. And it looks like you owe 200,000. The house is worth 300,000. So it's about 100,000 in equity. So here's what most people typically do. Rather than paying off the whole thing, because even if you could pay off the whole thing, it's probably gonna be really unaffordable. What most people typically do to save some money and also to what's called protect their equity they leave behind maybe 1, 2, or 3 years worth of mortgage payments. Now, does that idea make sense to you? They're going to say yes or no, regardless of like, hey, the reason that you might want to leave behind a few years of mortgage payments is to buy your son some time to figure things out, time to get the place cleaned up, cleaned out, listed, sold, time to mourn, time to go through your closet. Hey, he's got to travel from Washington to New Mexico to get this taken care of. He's probably not going to do it all in one weekend. Hey, God forbid there's another 2008 situation like with the real estate market. We want to make sure that he has time to let that market rebound. So your house is worth, 300 right now, but what happens if the market crashes and your house is worth 215? Now you go from 100,000 in equity down to 15,000 in equity. You see why you might want to have some time for that to rebound, right? So now I haven't pitched him on a specific price. I'm pitching him on a concept here. I'm getting him sold on the idea of equity protection over paying off the whole thing. So you see why a solution like that, John, would make sense, right? You see why a solution like that to give your son some time would be valuable, right? Now he's like, yeah, I see why that solution would be valuable. Now his mind is completely off of paying off the whole mortgage because, I can't tell you how many, I want to pay off the whole mortgage or I don't want anything at all. And then it's like, now I build up this idea of why equity protection. Hey, if you were my dad, this is what I would do. Hey, if you were this, here's what most people do. And now their mind is completely off of paying off the whole house. And now they're like, okay, I see why equity protection would make sense. And now it's not a 30,000. So it's like, I want a $200,000 policy. And you're like, hey, I'll give you a $30,000 policy. And like, if you don't build up that value, they're like, no, that makes no sense. Now, what's 30,000 going to do for me? 30,000. And it's like, hey, John, this is not a $30,000 policy. This is a big, big line right here, guys. So if you have 100,000 in equity and you're pitching a $30,000 policy, John, this is not a $30,000 policy. This is a $130,000 policy. You wanna know why? Because we're going to use that 30,000 to protect the 100,000. Do you realize that the 100,000 in equity you have in this house, that's your life insurance. That's your legacy. That's what we're leaving behind. If we don't have this 30,000, your son's going to have to sell. Maybe he gets lucky and he sells it at the top of the market. Everything's good. But the reason we get insurance is not for the best day. It's for the worst day. Worst day, meaning we're protected in case the economy goes down. We're protected in case he's not emotionally available or physically available to get the house cleaned up, cleaned out, listed and sold. He's got time to figure it out. No quick financial decisions. So now it's not a $30,000 policy. It's a $130,000 policy.
Yeah, that's so good. And recently using that exact explanation, got a senior on the phone and it was mortgage protection, almost exact scenario. He had like a $200,000 mortgage and he gets on the phone. He's upset. He's like, yeah, some guy tried to sell me a $200 a month, $10,000 policy last Friday. And I'm thinking, okay, that's about exactly what I was getting ready to show you, and went through that explanation and the exact policy with the exact carrier for the exact price. He said, no way. A week ago, he's like, yeah, that makes so much sense. Let's go ahead and get it. And we got him set up for that exact policy, because then I was able to show him how this was actually doing what he wanted to do, protecting the equity versus just selling him $10,000 policy. One more scenario. I just thought about this and I don't know. I actually don't know what you do in this scenario. I've come up with my own solution to it, but let's say it's the healthy 40 or 50-year-old, that makes a decent income. They make 60, 70, 80 grand, maybe even 100 grand a year. They're single, they have no kids, and they're a mortgage protection lead. Here they are. They're here to talk about it, but they're like, I don't care what happens to me after I die. The house goes back to the bank. I'm not here to even worry about it. That's what they say. What do you do in that situation?
So in that scenario, I want to sell on the selfish benefits of life insurance. So life insurance typically, hey, John, life insurance typically is a very selfless purchase. You're purchasing it for somebody else because you're not going to be here to use it. You get a $300,000 policy, you die, it goes to your wife. You don't have a wife. You die, it goes to your son. You don't have any kids. You got your brother. Okay, that's cool. We can put him down as a beneficiary because obviously we want to make sure someone gets something if you pass away. But most people, here's what most people, John, in your situation do, who are 50 and single and, really just trying to build income here. And they really value their income, is most of them, they're not as worried about if they die. They're worried about what happens if they get sick or disabled and don't die. They're worried about what happens if they can't work. So what most people in your situation typically want is they want the living benefits, which isn't included in most life insurance, which mortgage protection is included: the heart attack, the stroke, the cancer, the disability, the cash back. You want to be here in 30 years? Yeah. Okay. The cash back policy, great policy. They're going to give you back $139,000 in cash back if you outlive the policy. If you die, they're going to give, or if you get the living benefits, you need it up to 250,000 or 450,000 in living benefits, so, you see why something like that would be valuable, right? Now I'm playing on their selfish side of like, you're not gonna be able to make your mortgage payment if you get sick. You're not gonna be able to make your mortgage payment if you become disabled. Hey, this policy is going to take care of XYZ. You're planning to be here, right? Yes. Okay. But obviously if you're not, your brother's gonna be taken care of, which is a bonus. You see how that would be good, right? Okay, great. Well, if nothing happens, they're going to give you back $139,000 at the end of the 30 years in a tax-free savings account. It's like a nice little nest egg that you weren't even planning for.
I would add one more thing to that is you can even in that scenario do like a different version of equity protection.
Yeah.
So, I remember I was talking to a woman, she made $50,000 a year and, she had a decent sized mortgage. She didn't have a huge budget. Bills were tight. And, having a full mortgage payoff was not an interest to her. Affording a full mortgage payoff was not an interest to her. Right. So we did, I think $100,000 policy with 100% living benefits. And instead of just saying, oh, this is $100,000 policy, I'm like, hey, Mary, this is 2 years of your income. Right. So heart attack, cancer, stroke, all these things happen. You have 2 years of your income set aside to get back on your feet. Right. Because again, you're building equity in the house, but if you lose your income, you lose your ability to pay. So therefore, we're protecting the equity. So just, another way to play on equity protection for that client.
And guys, I think it's like the one thing I just thought of there is like the same benefit, $100,000. Josh and I could have described that to Mary in like 10 different ways about why that's valuable. Hey, you're going to get $100,000 benefit if this happens. He said, hey, this is 2 years of your income. She's like conceptualizing. Okay, it would take me 2 years to earn that. Okay, I got 2 years to figure it out. I could say, Mary, that's 36 mortgage payments. Like you could break that down into, hey, $100,000, this is going to be 10,000 for your burial. It's going to be 20,000 for that kid, 20,000 for that kid, 30,000 for this, that. And it's like how you break that down is how you build the value to the client. So like, depending on what they find valuable, depending on like you go through like, what is the financial situation going to be of the survivor? Well, I'm single. Okay. Well, if you're single, we need to focus on the living benefits to make sense for you. Okay. Oh, it's for your kids. Okay. Well, what does that need to look for? You have 4 kids. Okay. Let's make sure that each of the kids is equally taken care of. Oh, you want to make sure that not only do you have a funeral, but you also have a giant statue at the cemetery as well. Like let's put some money aside for that. Okay. That's too expensive. Okay. Would you rather your kids go from 25,000 each to 10,000 each, or you want to get rid of the statue? Like I'm removing benefits to bring the face amount down, to bring the price down. I'm not just saying, hey, $200 is too expensive. How about 150? Oh, 150 doesn't work. How about 100? Oh, 100 doesn't work. How about 75? Instead of just downselling price wise, I remove benefits. So I'm like, do you want to leave less money for your kids? Do you want to get rid of the statue at the cemetery? Do you want to go from the golden casket to the pine box? Like, what do we, you want to make someone else to clean out your apartment? Your kids have to do it instead of the professional cleaning service. Like, what are we removing?
That's good. I mean, I sold a policy the other day. It was $600 a month. And she goes, well, do you have any other options? And I said, well, yeah, of course. But all of the other options, we would either have to lengthen the life of the policy or decrease the coverage. Do you want to do one of those? Well, no, I want the whole thing. It's like, okay, well, then it's 600. And of course she went with it. So to your point. So, and especially if you're doing telesales, right, in the home, this is easier to do because it's visual, right? You can show things, you can draw things. Over the phone, you can't, right? So it's the difference between going, hey, John, this is a $10,000 policy. It's $100 a month, right? That's just very okay. And you're just the quoter guy now, versus explaining the benefits. And it's all marketing, right? In a sense that you can go buy a Chevy, right? Or you can buy, a 1950, Chevy, blah, 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 that's cherry red convertible with with whatever, right? And it's like, oh, that sounds a lot better, right? And so when you hear these things, that's the way you want to use them to explain the value of it. Well,
it's just like the difference between like, how the heck did you just sell a $10,000 policy to someone who's looking to pay off their $200,000 mortgage? It's value. Yeah. Like I was able to show value over the price. The other guy just showed price and he said, hey, for $10,000, it'll be $200 a month. And he's like, that doesn't make any sense. You're like, here's all the things the $10,000 is going to do. Here's all the things the $10,000 is going to protect. And now that $200 became a lot more valuable.
Let's see. The only other scenario that's coming to mind would be the person who is above 70. They're in there somewhere between 70 to 80. They do have the budget for a big policy. Maybe it's $100,000 or $200,000 mortgage, but they're having a hard time like mentally justifying doing that. Like you've asked them, why do you want? Hey, I want to pay off the house for my spouse. I want to pay off the house for my kids. It is important. Maybe I make 6-7 grand a month. I'm only living on 2 because I've been a good steward of my money. Everything's paid off. Anything that you would say to that person who has shown interest in the ability to qualify and pay, but they're not sure?
Are they healthy?
Healthy enough.
Healthy enough to qualify for anything?
Yeah.
Yeah, I mean, in that scenario, it depends if we're going to go whole life or term, like what direction that I'm obviously going to break this down. If we're going to go, the route of a whole life, like maybe like an IULE or something like that, in that scenario, I'm really going to be leveraging that they're putting money into something that has cash value, and that they're going to have something that's going to last past age 100, and that today's the oldest you've ever been, the youngest you'll ever be. Today's the cheapest that life insurance will ever be again. And at this point, anything you put in the bank is going to grow at virtually 0% interest or less than 0% with inflation, so let's leverage the life insurance company's money instead of leveraging your money, in a savings account is typically the route that I would go.
Exactly. I think that the main part there is just explaining that your money is still your money. It's going into the account, no matter if it's going to the bank account, the bank's bank account, or the insurance company's bank account, right? If it has cash value, it's an IUL, it's whole life, whatever. And so it's like, hey, John, look, we all have bills that we have to pay. We have money we have to live on. Some of us, like yourself, is fortunate enough to have money that you can leave on, that you're not going to use. And you can have that sit in the bank. It's not going to earn any money. And the price of everything is going up. Inflation's eating it away. And when you pass on, right, it's going to go to your kid at a fraction of that. It's probably going to get taxed. Mm-hmm. Or you can just take some of that money, put it over in the insurance company's bank account. They're going to give you a bunch of insurance for it. You get a big benefit while you're alive. You get the living benefits, of course. And then when you pass on, it's going to multiply tax-free to your kids. Either way, it's still going to sit in an account.
That's right.
And that exact explanation helped me to sell my biggest policy I've ever sold to, a guy who had just turned 80 years old.
Love it. Okay. I got a couple for you, and then we'll get out of here. Also, if anybody has any scenarios they want to throw in the chat, we're happy to maybe field 1 or 2 of those. Let's say somebody who's in their 20s to 30s, perfectly healthy. You're thinking slam dunk, home run, CBO, and denied. And then what's the first question that you follow up with when you see that somebody's denied, when you think they got no health issues?
Well, for me, first thing is driving record.
Any DUIs, reckless driving, felonies?
Yep.
Oh yeah, Josh, I actually had a felony about 6 years ago for assaulting an officer.
Yeah. That's tough.
So now what are we going to do?
Well, okay. So it's been 6 years ago, right? I'm thinking that
already denied a America prescription check.
Yeah. Already denied. Yeah. 6 years ago, there's not a lot we can do. So, it's like, hey, listen, here's what we're going to do. All right. Here's what we're going to do. The number one cause for people to, die at your age is an accident. Okay. And so we have a plan over here, and you're pre-approved to get up to $500,000 of accidental coverage, right? It's going to be X amount of dollars per month. And if you don't live in Georgia, right, we can click a button, and after 30 years, you get all your money back. So if you're anything like me, I'm really good at paying my bills. I wish I was a little bit better at saving my money. So you're 23 right now. So when you're 53, right, you're going to get back a big chunk of money, and you can maybe use this to pay off the mortgage earlier, or just assist your retirement. But you're going to get $500,000 of coverage when you need it the most.
Yep, that's good. So if you got somebody, guys, who is between the ages of 20 and 40 who has a felony, really there's only a couple scenarios you can do. You can go accidental with ROP. And then there's a few carriers. I believe we've got like AmAm Family Choice and Transamerica Senior Choice that you can get a whole life for somebody that's 18 to 40. So that's something for anybody there. Like you can still get them like a $10,000 to $50,000 whole life policy. It's going to be pretty cheap, but at least you can get them something that has natural cause coverage, because in those final expense applications, they don't ask about felonies. Really, felonies are a big deal when it comes to term products.
Yeah.
That's where the big deal is. So if you get somebody who now is 40 and above with a felony, pivot to whole life. Pivot over to any of our carriers, America, Mutual of Omaha, et cetera. Now you're kind of walking them off of, again, big coverage, but you're putting them in big coverage with accidental, and you're showing them the value behind why that makes sense for them. Hey, you're Bob, you have 0 medications. You'd probably agree you ride a motorcycle, the most likely cause of death. I don't know if they're robbing banks on a motorcycle or something, but you ride a motorcycle, the most likely cause of death is probably going to be an accident. So you see why $500,000 of cash back would make sense. And we're going to throw $20,000 in case, it is natural causes and you've got XYZ taken care of.
And especially on telesales, again, explaining things over and over in a way that they understand. I really like when you put those two together, instead of just saying, hey, you got this whole life policy for 20,000 and you got this accidental coverage for $500,000. Or whatever the number is, it doesn't matter with a number. You can say it's something like, okay, here we have this, we have this package here that, if you pass away for any reason, it's going to pay out $50,000. However, if you pass away from any non-natural cause, car crash, slip and fall, choke and die, it's going to pay out $500,000, right? So $500,000 / 50,000 equals $100 a month.
And 75 of that is the accidental and 25 is the whole life, or vice versa, but the client, it's how you package it. So now it's like, hey, it's $100 a month. It's $100 a month for 550,000 in coverage.
Mm-hmm.
Oh, wow. But 500 of it's accidental and 50,000 of it's whole life. So again, it's all about how you package that solution to the client. Let's see if we got another one. So this one's from Sam. Older person in their 60s, someone who has a good income, a lot of assets or investments. They want mortgage protection. They're surprised at the price and they just want to sell their assets instead of getting life insurance. So they kind of want to self-insure.
Self-insure. Yeah. So, a couple different ways, right? Of course, you see that. And the first thing you're hitting them with is like, hey, you can pay off the whole thing. And of course, you just said it. They're coming back with, oh, well, we'll just sell off the assets. So what they're saying is, I don't want to pay that price. I don't see the value in paying that off. Right. So we're probably just going to go back to equity protection. Hey, yeah, totally. Right. You pass away tomorrow and Mary over here has to go find all of your accounts. She's got to submit all the paperwork to HR, to whoever, and however long that's going to take them to sell off those assets. Right. And so what the great thing about insurance is it pays quick. Right. You call the company, you submit a death claim. Many times once they get the death certificate, they're going to pay out that money within 7 days. Right. So you don't have to wait for those assets to come in. Right. And, one of my first big sales was because of that. It was a guy in his 70s, retired attorney, had lots of assets, had $100,000 sitting in his checking account. He told me, and he goes, yeah, I got all these assets, but I don't want my wife to have to wait and dip into all these different ones and go, do I dip into this one or dip into that one and not know the ramifications and have to talk to my tax attorney or the CPA? I'm just going to get her a $40,000 whole life. That's going to take care of my final expenses, leave some money behind to pay all the ancillary bills while she's waiting for all this money to come in.
Any other scenarios you can think of here? Sure, we can do a part 2 to this.
But. Yeah, I know. We'd come up with all sorts of things. I mean, let's see, maybe you mentioned young people, just, young people looking for life insurance. It's always kind of, honestly, it's kind of a rare thing for a 20 or 30 something to, get mortgage protection or life insurance, especially just life insurance, a life insurance lead in general.
Yeah.
Right. Usually maybe if they have kids, it's like important, but like, what would you say to a young person who's like sitting at the table and they go, yeah, I know I need it, but like, I'm young.
Yeah. I mean, in that scenario, I'm talking about other people who were young, who didn't have it. And, what that maybe did for their families, talking about, friends who were young that got sick or got hurt and couldn't work. Really leveraging like young people, they're selfish, like until they have, I know I was, at least until I got a spouse. And then once I had kids, like you really start thinking about that stuff. Like someone pitched me on life insurance when I was 18 and single. And I was like, I'm never going to die, man. Like I'm good. Like, why would I do that? Someone pitched me on an IUL when I was 19, and I wish I would have done it, because I would have had 11 years of compound interest on an IUL, and it would have been fantastic. But in that scenario, I really want to leverage if I'm a young person, you're talking about IUL, I think is a really cool thing, because something that can build cash value. Hey, we're setting yourself up for retirement early. I'm talking about living benefits, and I'm talking about how it's the cheapest it's ever going to be today. Talking about how when you're 30, 40, 50 years old, like, here's the difference. Like, this is going to go from $40 a month to $300 a month if you decide to wait. So if they have any sort of loved one, then I'm obviously, leveraging, that for the death benefit if something happens to you. And just telling stories about, hey, like, there are plenty of scenarios where young people don't come home tomorrow. Like, you're not invincible. And you don't win all those. That's like someone says, hey, I have some people, they struggle with selling young people. Some people struggle with selling the 80-year-olds. I think, like, everybody, depending on the day, sometimes can struggle with those really young ones and the really old ones. Well, I'm gonna die anyways, so, like,
Yeah.
I don't need anything. They can just figure it out. Or, I'm never gonna die, so I don't need anything.
What I think it's, again, if you talk to somebody that's younger, right, they still filled out a lead. They're there for a reason. They're not just there, and you have to convince them why they need it. I think maybe, as you get older, you kind of come face to face with your mortality, and you've seen some things and your body isn't holding up. So we take a position of, here's what most people in your situation that have put it off do. But with a young person, we're kind of patting them on the back and congratulating them and saying, hey, you're ahead of the curve. And here's what most people your age don't know. And if you do these things, you're going to be ahead, right? And the living benefits, cash back options, IULs, setting yourself up for the future. And, if you do these things, you're going to be, head and shoulders above everybody else that hasn't taken the time to do that. So, like, I just congratulate you that you're thinking about these things before most people have. You're going to be in such a great spot and feel so good, 5, 10, 15 years from now that you've made this decision. So I think you just take the opposite approach and talk about some of those things that's going to set them up. I know if somebody would have taken me aside, would I have listened to them? Maybe not, but quite possibly I would have.
Awesome. Well, guys, we'll get some feedback from everybody who did tune into this call. If this is something that you guys enjoyed and want us to break down more scenarios, and maybe next time come a little bit more prepared with scenarios from the group, like things you guys have actually experienced, like, hey, I encountered this, like, how would you, I think that might be more powerful moving forward, is, hey, I encountered this and couldn't make the sale. What would you have done? And we could bring some different guests on here. And I think that
what we should do is, like, collect some inventories.
Yeah.
Obviously not personal information, but, like, here was a case I had on somebody, and then we can just, like, dive into them how we would.
Yeah, that could be cool. We can put the financial inventory on the screen and say, hey, here's what I would have done if you would have sent me that financial inventory and I would have been in the house. So awesome, guys. Well, we appreciate y'all. I hope everybody has an amazing night. We are going to get back to live dials, and there's lots of people with lots of appointments, and Insurance 101. I will see y'all Thursday at 9 p.m. Eastern time. I appreciate y'all. I hope everybody has an amazing night. Peace out, guys.